You're live now?
Yeah,
I can't see anything on YouTube, that's why.
maybe a couple of minutes later.
Okay. Hello, everyone. Welcome to today's live webinar on recession. So, before we start, we did a small activity in social media. We, in fact, posted a question asking about recession. And the response that we received from our followers was that people asked us questions on what is a recession and how to save money. So, which gave us an idea that a good number of social media followers and people, working class people are quite unaware about what a recession is or what steps should one do during a recessionary period, how to save money or where to invest their money. So in today's webinar, we will be talking about these points only. So in order for you to know what is a recession and how to save money or how to spend or spend, where to put your money. To know more about this, I would suggest that you stay tuned till the end of this webinar, and I'm sure that the takeaway from this would definitely have a lasting impact on you during the next 1 or 2 years of time. So let's quickly start off with. So, like I said, in today's webinar, we will be talking about recession, and to know more briefly on what exactly we will be talking about a recession and what it is that first of all, what is recession? We will address that. Then, then we will talk about whether we are in a recession already or are we going towards a recessionary period. Then what are the measures of recovery from a recession, and is it beneficial for investors or not to invest during a recessionary period? And what should we do in terms of an investment strategy during a recessionary period, and where should we invest, and how to identify stocks during this time frame. So these are the topics that we would be addressing in today's webinar. And so of course, some of us are following mainstream media, and day in day out people are only talking about this, but still this webinar would have some takeaway, some positive takeaway will be there from this. So first, what is recession, and are we heading towards a recession or are we already in a recession? So, American economist Julius Shiskin. So, according to him, uh, recession can be defined as a period where the GDP of an economy has declined for two consecutive periods. So, back to back for 2 quarters, if the GDP growth rate has been declining, then that means that economy is actually heading towards a recession, or it is rather already in a recession. So in India, the RBI, Reserve Bank of India, that is the central bank of our country, will decide the span of recession or the specific dates to check for a recessionary period. So, for example, if you look at the second and third quarter, the GDP data of the second and third quarter of the year 2020, you will notice that the GDP rate had turned negative. It had in fact declined and then turned negative because of the pandemic and the lockdown that was imposed. So this was an indication that our economy is in a recession. This is one part or one data source or information source that one can look at to know whether an economy is in a recession. So another indicator or another information source is yield curve of government bonds. So whenever there is an inverted yield curve, uh, that is an indication that the economy is headed towards a recession. So, what is an inverted yield curve? So, most of us know what is yield. That is, in very layman's term, if one has to explain, it is basically like a return on your investment. So, the general understanding is that if you invest for a long term period or for a longer duration, your return is bound to be higher than the investment that you've made for a short term duration. Best example would be fixed deposits. If you invest for 5 years or 6 years, time frame, say 5 years time frame, the interest rates would be somewhere around 7 or 7.5%. And whereas if you invest only for 1 year or something, the interest rate would be somewhere around 5. So on this logic, so when you look at the yield curve of government securities or government bonds, when the yield from the short term investment is more lucrative, or if it's more advantageous to an investor than being invested on a long term, then that is an indication that the economy is headed towards a recession. The logic behind is, when the long term returns are declining or it is not favorable, then that means there is no future prospects in that economy. So when your short term investments are or higher when compared to long term, then that means after the short term period of say 1 year or 2 year, what next would be the question. So that would be an indication for one to know that okay, the short term investments, the return on short term investments are much better than being invested on long term, especially in government bonds and securities. For this discussion, that would tell you that okay, this particular economy or this country is headed towards a recession, or rather you can say that they are already in a recessionary period. Very recent example could be what is happening in UK now. A very similar situation over there. The inverted yield curve was noticed because of skyrocketing power prices. Besides this, when the GDP growth rate falls or slows down, that would be a more confirming indication for you, because every quarter the government posts its GDP numbers. So in India, if you see, the growth rate or the GDP rate for Q1 was 13.5 percentage, whereas the GDP rate for Q2 was 6.3. So almost half a percent decline. So which indicated that we are headed towards a recession, and that was because of the pandemic, and where the government had to impose a lockdown, uh, bringing down all economic activity to a standstill. Factories were shut down, and practically none of us had jobs for that 1 or 2 months of time. We had nothing to do. So when such an standstill event is imposed, what would happen is production will decline. When production declines, you have nothing to sell, and when you don't sell anything, you do not have any money. So basically, there is no activity happening in the economy. So if you want to know, have we been in a recession in the past? Was India affected by a recession in the past? Yes, we've had five different recessions in the past. So the first one would be in the year 57, 58, where we had a balance of payment crisis, wherein we did not have sufficient money with us to pay for the imports of essential goods. This was during 57, 58, just a decade after we obtained independence, and when we were trying to make it big among all the other established nations. Then there was a severe drought in 1965-66, followed by an energy crisis in the year 72-73, then an oil shock in the year 79 and 80. And after that, for almost 2 decades, 2 decades later, in the year 2021, we witnessed the pandemic. Current year, in the year 22, what we are now witnessing is another recessionary indication. uh, so if you notice the GDP rates, and if you're following the main business news, you will notice that the RBI had been increasing the interest rates, uh, at least in the last 2 3 MPC meetings, and which they were trying to do to curb inflation. But when you try to increase the interest rates to such an extent, what you trigger is a recession. So for it would be a little safer to say that we are heading towards a recession now, rather than to say that we are already in a recession. Because when you compare what is happening in India versus what has already happened in the other developed nations, we are not that severely impacted by the external events. Now, Now that we've understood what is a recession and basically how it affects a particular country or an economy, let us also understand what are the measures of recovery and what would be the impact on investing during a recessionary period. So, like I said earlier, that one way to curb inflation would be to increase the interest rate. So, the same thing, the reverse of that would be a measure to handle recession. So when the prices of basic essentials and commodities and everyday necessities are going up, that means people have too much money in hand, and because of that there is a decline in the supply which triggers the prices of the goods to go up. And in order to ensure that the money supply is kept under a check, or if it is being monitored carefully, they keep increasing the interest rate to such a point where they cannot increase it any further. And similarly, when there is an recessionary event happening in the economy, people generally don't tend to spend or invest in any sort of a commercial activity. Whatever money they have, they try to protect it to ensure that they are able to live through the recessionary period. In order to curb a recessionary situation, what the central government would or the central bank would do is they would reduce the interest rates. When they reduce the interest rates, loan products become more cheaper. Banks tend to give you loans at a much cheaper rate, which is attractive for individuals like us, like you and me, because when we have access to capital at a very cheaper rate, we always tend to think uh, where to invest or how to take advantage of this opportunity. So when we borrow that money and we have a good amount of capital with us, we would want to invest that somewhere or spend it. So either we spend or either we invest it, it doesn't matter, because that money what is with us is now getting invested into the economy, and that restarts the economic activity. So if you have 50,000 rupees with you as a loan that you've taken as a short term loan, and you want to go and buy a mobile phone, that means you're now spending this 50,000 in purchasing a phone. So if the demand for the phones was declined during the recession, then this will help in reviving that demand, because now uh, these mobile manufacturing companies know that people have money and they are willing to spend. So they also tend to make additional investments and in manufacturing activity and increase their production. That is one measure. Another measure would be to introduce new money into the market, which will help revive the economy. With people having fresh capital coming in, they tend to spend it. So that's how most people from neighboring nations and PE investors, what they know, do is they monitor the situation, and when they know that the investment opportunities are peaked up in a market which is affected by recession, they tend to bring in their capital and help revive such a market. And such foreign capital or such fresh capital introduced into the economy will help in reviving the economy, and at the same time coming out of the recessionary situation. Now, how individuals take advantage of this is when they have surplus amount with them, money which they don't want to be kept in their savings bank account, or if they're willing to take a bit of a risk, uh, because they identify opportunities that okay, the economy is reviving, now would be the right time to take advantage of this or to catch the train much earlier. They tend to invest that amount in stock markets. So stock markets have always proven to be a good passive source of income for salaried individuals or for the general public. That is, people who have a day job and at the same time who also have surplus capital, and they want to make their money uh, and they want to employ their money and make it work for themselves. In such situations, you should invest in the stocks of the right companies. And historically, if you look at the data, every time that an economy comes out of a recessionary period, 90% of the time the returns have always been positive. There have been very little instances where, even though the economy is out of recession, but the stock market has not performed. So you can always look at stock market as another external or a secondary source of information to confirm whether there is whether the economy is actually breathing with enough amount of capital, or is it struggling. Now, how to identify stocks that can beat a recession, or how to identify stocks that are not battered down because of a recession. So, you should look for companies that are fundamentally strong. When I say fundamentally strong, I'm not hinting uh, at a very financial in a terminology manner. So very basic safety checks that one can do is they can go through the balance sheet to see what amount of reserves the company has, and how much borrowings does the company have already, or what amount of loans they have newly taken up between one quarter to another quarter, and what is their asset position. So all of this information is easily available, and it is translated into a more uh, layman terminologies by quite a lot of websites that are there in market. Like you can refer to et money, money control, screeners. All these websites have this information. So as individuals, what we have to do is we have to look for stocks which are actually healthy, financially healthy. They have good revenue. Even though the economy might be in a recession, if the company is able to at least maintain the same revenue that it had earned in the pre recessionary period, then that means such companies are able to perform well even when the global markets are not doing that well. So our economy is not in isolation anymore at all. Has never been in isolation, actually. Not, I shouldn't be saying anymore. We've never been in isolation. We interact a lot with the other emerging markets and other economies. So any event that happens in one particular country tends to have an impact in our country, and that impact will also be there in our economy. So when you pick a stock, you need to ensure that you have a good understanding of that company's business model, whether that business model will survive the recessionary period or not. Of course, you as an individual, we cannot try to get a deeper understanding, but at least uh, from a very high level, or from a bird's eye view, if you say, you should understand what products they are selling, or what service segments are they operating in, and who are their customer segments. Is the company heavily dependent on export turnover, or is there a good revenue mix, that is, they're able to sell their products domestically as well as export. So if they are exporting, to which all countries are they exporting, and how badly are these countries affected in recession. The reason why we have to look at this is because when uh, when the entire world is going to be impacted by recession, then one thing which might be common is that all these customers in the other countries would not be willing to spend much, because their main objective would be to survive that period, and to be able to have a business post recessionary period. So in such a situation, we need to see whether these companies, or these markets that this company has targeted, will they be able to earn the same amount of income even during the recessionary period. That would be one point that we need to check. Then is this company heavily leveraged? So the reason why we should shy away from investing in highly leveraged companies is, even though there might be growth prospects, or the indication for borrowing more would be for expansion, but one thing which comes with loan commitments is a requirement to honor your debt instruments, that is the interest payment. So during the recessionary period, if the company is unable to generate sufficient cash for the daily operation, it will not be in a good position to pay out these fixed, commitments of interest. So in such a situation, we need to see what was the performance of this company in the past, and have they defaulted in repayment of loan under any economic situation. So if there was a repeated behavior of interest defaults in the pre-recessionary period, then the chances that the company would default it during the recession are also high, because they are not able to generate sufficient cash. So you should stay away from those companies. Then look at the net profit that this company is earning, uh, net profit in absolute terms, and also in a percentage terms. So any company that is able to generate 10 or 12 percentage of net profit margin can be considered to be a company which will give you a decent return. Of course, it doesn't mean that every company that is able to generate 10 or 12 percentage in net profit doesn't mean that the stock will perform exceptionally well also, even in the recessionary period. But these are certain checklists that we need to see to screen stocks or to pick out those stocks. Now, once you identify these stocks or your investment opportunities, what we should also do is we should have a very disciplined approach towards investing. We should, if you have a capital of 1 lakh, never invest that 1 lakh in a single stock, and at the same time, never invest a lakh, that entire amount, in one particular segment or an industry. It is always better to diversify your investment as well. So if you say that you will equally split that into five investment opportunities or five investment sectors, say 20,000 each, then you need to pick out stocks from those sectors. If you pick some stocks in IT, you should also pick some in banking, because when the economy recovers, or when it passes out from a recessionary period, all the segments put together take the economy out. So it is not that only one particular sector will do well, which will help the economy to come out. So you should always ensure that you have invested in all the five or four sectors that you choose equally. And then you should also have a small portion or a decent portion of your capital in fixed income, because even if all of these sectors don't perform well, at least you would have this capital protected, and you would get that fixed amount of return. So you should have a small FD part in your portfolio, and you should have an equitable distribution in the other sectors as well. The reason why we do this is to ensure that if one of the sectors does not do well, or if something adverse happens during that period and that sector is severely impacted, then that much amount of capital is what is at risk, and not the entire capital. So protecting your capital is more important than investing. So reasons, three reasons mainly why we need to invest during recession is that, so there is a common pattern or a behavior that whenever a news breaks, whenever there is a news breakout, um, market tends to take it in two ways. Uh, one way of one way the market would behave is that it would actually try to decode that news, and try to analyze how that news will impact on its future investments or on the current investments. So this part of the market are the uh, experts that you can say, or institutions that you can say, who generally don't react very quickly. They always try to analyze the information. And the second part of the market is where people see a news, and they don't read through the news. They see the high level news, and they actually react on that. So when there is a news that, okay, India is headed towards a recession, or the economy is already in a recession, the the first part of the market which actually reads this news is they try to understand all the numbers, and they see which are the sectors which are affected badly, or how bad is the situation, or how worse the situation can get. They try to project how bad things could get, and they accordingly behave, or accordingly they take decisions with respect to their investment. The retail sector, such as you and me, what we generally tend to do is when we see recession, the first thing that we do is we hit the panic button, and then we do selling, and then we try to exit all the positions. So this induces selling pressure because of fear. So when such a trigger is, when such a selling is triggered because of fear, the prices tend to go down. To add to this, if the institutions that also feel that yes, these companies would not perform well during the start of the recession, or as the recession progresses, even they tend to exit those sectors or those companies stocks. So what this does is, it results in the prices of the stock declining very quickly. So, if one good example would be, if you look at what happened in March 2020, when we accepted that yes, there is a proper a, an outbreak in our country of COVID outbreak, and when the government announced lockdown, most of the stocks were down by almost 50, 60, or even 70 percentage from their from the prices that were prevailing as of March. What these stocks sent out as a message was that for all these institutional investors or people who read through and understand the message, this was a buying opportunity for them that will not come back again. So these are the guys who took advantage of this event, and they invested heavily. Some of them, in fact, they borrowed money and they have invested, because they knew that every time there is a decline in the price, there would be a rebound, and that rebound would be very, very quick and very fast. So if a stock falls from 30 to 20, that doesn't mean when it rebounds, it will come back to 30. There is a good chance that it will cross 30 and go till 50, 60, or even give you fourfold return. It could become a multi-bagger. So such situations, what you and I, or as the general public, what we need to do is the retail segment. We need to monitor stocks. We need to look for fundamentally strong stocks. Keep them in your watch list and wait for the right time to invest. So if there is a downward trend, then once the downward trend ends, there would be a consolidation where people will start accumulating the stocks at such a discounted price, and then the stock begins to start its upward trend. So this is when you will be benefited from the investment decision that you make. So supposingly, if recession starts in December, and if the stocks have fallen down by 15, 20, or 30%, for example, you should not invest entire money in at that point, because you would be thinking that that is the bottom, but you'll never know how deep the stock prices can go. So what you should do is, like I said, you should have a disciplined approach towards investing also. Break your capital and don't invest the entire amount in one go. Try to invest 20% of your capital in a stock, and then monitor it for some time. And if the selling pressure is still intensified, then it could go further down, which would give you an opportunity to buy more and average. But at the same time, you should draw a line to say that beyond this point, I will not invest anymore in this particular stock or in that sector, because there's no point in trying to catch a falling knife, because it will just take you down, and you would end up uh, completely blowing up your entire capital. Once you've identified the stocks and you've invested, what you should also do is you should have conviction towards your decision and stay throughout the recessionary period, because most people who stayed invested during the recession have reaped the benefits when the market has revived and the stock prices have gone up, than those who have made an early exit. So you should know when to enter into a stock, and at the same time, you should also know when to exit. Of course, you can never time it. There is no rule book to say that any stock that falls 20% is a good entry point. No, it is a personalized decision that you take, and you need to take that decision only after analyzing all the information. Try to compare that stock's performance with its peers and see how the peers have declined. Try to compare the revenue. So these, all of this information is available. You don't have to break your head and read through company financials or anything. So you can visit all these financial websites and they give you all of this information in comparison with the peers, so to help you make your decision. At the same time, try to invest in those sectors or stocks which are defensive, meaning essentials. You can invest in consumer discretionary stocks. You can invest in textiles. You can invest in toothpaste companies, because all of these will not run out of business unless they are fundamentally very weak. Fundamentally strong stocks, and if they are the basic essentials, then that means these stocks are going to perform. Yes, they may not perform as good as how they were before the recession, but at least they will be able to survive through with a decent amount of profit. Now, where to invest? Since we spoke a lot about stocks, should we invest only in stocks, or do we have other investment opportunities or avenues where we can invest? So the reason why we started with stocks is stocks give you a liquidity access. If you invest 100 rupees today and tomorrow you have some emergency, even though the prices may have gone down, you can quickly exit your position and take the capital when you need the money the most, as this gives you the easiest way to exit, to liquidate your amount. Besides stock, what other investment opportunities or avenues that one can look for is investing in traditional items such as gold. So this again goes back to the understanding which has been or the notion that is there in our country, that gold is always good. So we always tend to buy more gold, and we are practically obsessed with gold because we import a lot of gold from the Middle East. So during a recessionary period, the prices of these will not decline, and it would be considered as a one of the best investment avenues. However, you should not put your entire money there, because you should also consider what would be the return and whether that return is justified for investing and for staying through the investment horizon. Then, like I already mentioned, you should also have some amount of your capital invested in FDs, even though the returns are low, but it is a guaranteed return. It is not subject to any sort of a market risk, unless the bank in which you've created the FD itself is at risk. You should avoid cryptocurrency, because generally cryptocurrency is a volatile market, uh, and during a recession, this volatility would only be peaked by x times. So a currency that is trading at say 20 rupees today could be trading at 200 rupees tomorrow, and at the same time it could become 1 rupee the day after. So such would be the volatility in crypto space, and you should try to stay away from crypto unless you know what you're doing. So if you are a retail investor and if you are a beginner, then try to avoid investing or trading. There's no question of investing, it's more of a trading in crypto. Try to avoid crypto. Then try to stay invested for a longer duration, because the returns that you make when you've invested for a long term period, because of the compounding effect, is much better than trying to have a short term investment. Yes, short term investments will be good, no denying that one. If you buy a stock at its bottom, you will probably make 30%, 40%, or even 50% return. But in order for you to get the best returns, try to be invested in those stocks for at least 2 years or 3 years time, as once the economy is out of recession, like I've already mentioned, the commercial activity would be so intensified that now, if there was a decline in GDP by 6%, we would try to, the economy will try to recover that 6% and additionally put in another 6 to 10 percentage in terms of growth. That much, uh, you know, that intensified developmental activity is what we will witness in the post recessionary period. So to be on the winning side of such an activity, you should stay invested in the stocks that you've already selected. So you can consider investing in real estate, but once the prices of immobile properties take a hit during a recessionary period, the rebound is not that swift, because real estate space as such is heavily dependent on raw materials and construction cost. And these sectors don't, or this sector doesn't generally tend to perform very well, as the time frame or the gestation period is very very big for them. They will never recover the market, or the market will never recover in 1 year's time. It will take 5 years or 6 years time. And investing in real estate is never easy. You would need at least 10, 20, or even 30 lakhs of capital to invest in a decent plot. So it is better to shy away from real estate as well, unless you have idle capital and you are willing to stay through that period. So we spoke about recession. We spoke about how to protect your money, or how to ensure that you have created a revenue source for the in the recessionary period. Now we should also know how to protect this. So um, just because we have invested our capital in the stock market, or we have created some FT, doesn't mean that we are invincible. So we as human have to try to take care of ourselves. So the 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 next thing what can happen to an individual is not guaranteed. So it is always advisable to have an insurance policy taken during the recessionary period. Try to have a decent health insurance cover, and try to avoid pledging your stocks and then taking a loan on that to meet your emergency requirements. So if you for your health, if you've taken a health cover, at the same time try to have some cash, surplus cash, just to ensure that whatever unforeseen emergency needs are there that you may have to deal with, you at least have some amount of money in hand to meet out that one. During the COVID, most of us realized that job security is very limited in such um, in such times, because these are not man-made events, or events which are controlled by one single individual or a government or a company. So everyone would try to protect themselves. So you should have some amount of savings with you to ensure that even if during a recession, if you lose your job, you at least have 3 or 6 months of monthly income in hand, to ensure that you're able to find another job and keep the fixed income coming in. So that is it with what is recession, and how to deal with recession, or where to invest during a recessionary period. So I hope this webinar has helped you out in some way. So if you have any questions, you can post them in the chat box, and I'll take them up now. Thank you. So Mr. Mahesh, like I said earlier, if you already have the amount with you, and if you're not considering to take a home loan, then you could look for a property now. You could scout the market and try to identify certain potential properties, and also evaluate whether the prices are affordable and reasonable, because today real estate market is a bit premium than what was there 2 years back. So if you're not looking to invest very quickly, what you could do is you could hold off on this investment, park this money in partly in FDs and partly in mutual funds, and wait for the right time. and when the time is right, you will be able to you will know that the prices have come down, or you would have found the right house or a building or a commercial plot or anything, and at that point you can invest. But if you're considering to take a loan, this might not be the right time, unless your earning potential is 20 lakhs and above, or anything above 15 lakhs, where even if you take a housing loan, the EMI would not be a major pinch, because you will get some tax benefits on that housing loan, so it would offset the tax outgo. So no, Mr. Anirban, with respect to SIP, it is not advisable to stop, because, like I said, when you started an SIP, your mindset or your intention was for a, longer time frame. So, for, like, say, a 10-year time duration, or a 15-year time duration, or you're planning to build your retirement corpus. So during a recession, you should continue with your SIP, because your NAV value will decline at that point, and the SIP that you started before would become very attractive now, and you could consider increasing your SIP amount rather than stopping it, unless this affects your monthly income. If there is a decline in your monthly income, then you should try to not increase your SIP value, rather try to retain the SIP value. Mutual funds, yes, you can always consider, but try to avoid investing in small caps, because they are the most affected sector. Whenever the index, their beta is much higher. So whenever the markets tend to decline more than the large cap companies or the companies which are there in Nifty 50, these would be the most affected. Passive mutual funds you could consider, but again, you should try to see in which companies that mutual fund has invested in, or in which all sectors they have invested in, and then you should take a call on that. uh, yes, Ms. Ravina, if you've missed the investment declaration deadline, you can always include your investments at the time of filing ITR, and claim the benefit. However, you should have made that investment before 31st March. uh, to answer Ms. Banerjee's question, there is, like I said, there is no major part in a portfolio. Your portfolio should not be consisting of a single stock, or stock representing a single sector. It should be equally distributed among the major sectors, I would say, and that is the best investment strategy to apply. So defensive stocks are those which are not or which would not be severely impacted by any decline in the economic activity. So people need to eat and drink. So if you're investing in stocks that are in consumer discretionary, or just for this discussion, if I have to pick a stock, I could say Reliance Retail or DMart. So these are the stocks which actually sell your daily essentials that are required. So even during the COVID time, these stocks were not severely impacted, because the number of people visiting the stores to buy their daily groceries has never fallen, has never declined, unless there is a drought, or the food production is acutely short, or we are not able to grow enough food to feed the people in our country. Such a situation will never occur for us. uh, so you should consider If there are no other questions, then I would be ending the session now. And thank you for your time. And do be subscribed to our channel. You would find quite a lot of exciting webinars coming up. Thank you, guys.